A very good morning, good afternoon or good evening to everyone who is dialed in today to our first Lacima webinar. On behalf of the entire EX group, I would like to welcome you as our guests and also welcome our hosts today, which are Chris Strickland and Martin Otkin from Lacima. Lacima is a team who joined EX Group a while ago, earlier this year, and we are very happy to have them with us in the group, but also happy to share their expertise and what they can offer to the market today, and in a series of webinars in the next weeks and months. The webinars will focus on a couple of topics which have been brought up by market participants, and we will show how Lacima and the EX Group can address those issues and those topics. And today we will start the session with a webinar about capturing the value in gas swing contracts in the European markets. For your information, the session will be recorded. It will be made public later on our YouTube channel. You will find for your convenience a Q&A box where you can post your questions or your comments. We will try to pick them up as we move along and also at the end of the meeting. And now, without further ado, I would like to hand over to Chris, who is founder of Lacima.
Thank you very much, Daniel. Welcome everyone to this first in a series of webinars using our solutions to look at the issue of capturing the value in gas swing contracts in the European markets. So I'll start off with the normal disclaimer. We're going to portray ourselves as experts, but you can't trust anything we say. Don't use this to trade on or any of these normal disclaimers that we need to make at the start of a session. Okay, I have a couple of slides in the beginning to introduce the two presenters today, and then a little bit about the presentation. One slide to talk about what we do as a company. So the two presenters are going to be myself. My name is Chris Strickland. I'm one of the management team and one of the original co-founders of Lacima. And then the other presenter will be Martin Ogden. Martin heads up all of our client conversations around the areas that are covered by Lacima Trader and LNG. Martin used to be a trader himself in the European markets, trading gas and LNG, so he brings some excellent insights into the functionality that we produce in our software and helps our clients to use that software. Okay, Lacima then, our vision statement, mission statement really is that we look to empower confident decision making for energy and commodity market participants through our software, through superior innovative analytics and insights. So in terms of what kinds of markets we operate in, our clients have portfolios that contain power, thermal, wind, hydro, solar, power plants, gas clients, which is obviously the subject of today's session, swing, storage, LNG, oil and products. We have clients in the agricultural space, trade soy, sugar, etc., and also in the metal space. So we have a set of software solutions. The two main ones are here, and those software solutions use the same underlying models and methodologies, which leads to consistency between these two blue boxes. The box on the left-hand side is essentially what we're using today to do the analysis of these gas swing contracts. It's an Excel plugin. It's really aimed at deal valuation, analysis, structuring deals, simulations. It has individual libraries around building sort of power and gas forward curves, standard derivative pricing, fixed and index gas swing contracts, gas storage facilities, gas transportation deals, etc. And so we have a set of functionality there which is really used to structure deals and to try and gain insights into what's driving the values that we get. And then on the right hand side we have a Windows application that's primarily used as a portfolio level calculator. So our clients use that as the RM to their ETRM. They run mark to market, P&L attribution, value at risk, gross margin at risk, earnings at risk, all those sort of market risk metrics, and PFE on the credit side. Within Lacima Analytics as well, we do a lot of work, and it's going to be the subject of the next webinar, around LNG, so deal valuation, individual deal valuation, looking at flex terms, portfolio analysis of LNG deals and simple contracts, hedge contracts. There's a lot of functionality in there around stress testing and scenario analysis. So those are the areas that we operate in from a software perspective. The analysis that we do today is coming out of that dark blue left-hand box, and so that's what we're going to concentrate on. Just as a flag, you've probably seen it through other materials as well, but this is the first in a series of 4 webinars. So we're looking at the valuation gas swing contracts today. In 2 weeks' time, we're looking at trying to give insights into the valuation of flexibility in structured LNG trades. So these are trades where the buyer has the ability to cancel cargoes, uplift cargoes, change destination ports, change volumes, change pricing indexes, etc. Now, for the people in Europe, this is a bit of a unsociable time because it's really aimed at the majority of our clients in this space who are out of Singapore. So this is at 10 AM Singapore time, but the others are all at similar time to today's. So the third one in about a month's time is going to be looking at how to profit from spreads between European gas hubs, transportation deals, Area D type contracts, how to value those, how to hedge those, how to analyze the cash flows and the risks associated with that. And then the final one, which is gives you a break over the Christmas period, is more focused on these sort of portfolio level calculations. How do you measure risk in portfolios of power and gas contracts across different regions, different types of derivatives, futures, swaps, options? How do you measure that risk? And then how do you understand where are the hotspots? How do you gain insights into what's driving the risk? How do you gain insights into the changes between yesterday and today? All right, so hopefully that's a quick introduction to Lacima. I'm going to hand over to Martin now to talk about some of the background for the last year or so in the European gas markets and the kinds of deals that people are looking at, and then we'll analyse one of those deals when I pick it back up afterwards. You're on mute, Martin.
There we go. Yes, thank you, everybody. So today we're going to be going through swing contracts. So I'm going to go through a quick overview of the market, what's been going on, what's been driving prices, etc. Then we'll look through an example deal, see how that deal looks, what are the main drivers behind it, and then we'll go through how to value the deal, how to simulate the deal, and how to work out what the deal is worth. So starting here through what the market background is for the deal. So recent history, As you guys will, I'm sure, have been aware in the press, we've seen really high volatility, high prices. We had the COVID shutdown in early 2020, a series of supply shocks. Firstly, shutting in of supply really in early 2020, and then additional demand jumping up as COVID reopened through 2021. On top of that, there's been a lot of structural change going on in Europe, with a big drive towards renewables and away from fossils, especially coal and partly gas, going through kind of from 2020 to 2022, and the war in Ukraine. So we've seen kind of headlines, as we're seeing up here, issues around Ukrainian flows and risks through flows through Ukraine, record European gas prices, issues to do with Nord Stream and flows through Nord Stream. Looking at prices, I think this really speaks for itself. So here we're seeing TTF prices from 2019 through to 2022. So you can see prices, a lot of us have become very short term, thinking that things have been happening really since the war in Ukraine, which is really the far right hand side of that chart. But things in the European market have really started heating up over a year ago now, so through October 2021 onwards. So there's been a big jump in volatility. That jump in volatility has been sustained for a very long period. Where are we at the moment? What's the current environment? So the mix of things is changing all the time. This is what's important to stay on top of from a trading perspective. This also shows you where the opportunities and risks are in the market. So we're seeing German storage now 95% full. So that creates an interesting new dynamic where if German storage becomes completely full, where does the gas go? What happens to prices? What assets and deals are good to have in a trading portfolio to take advantage of that? Price caps and controls. So Europe's looking at introducing various types of caps and controls. What are the effects of those? The ongoing risks around war in Ukraine, issues around infrastructure. So Nord Stream, as we've mentioned, associated transit infrastructure through countries like Ukraine. And then issues around the weather. So weather, a lot of people think hot and cold. Yes, that does play into it, but a really big factor now is wind. So a third of Germany's power production is wind. So when it's very, very windy, gas demand falls, and when it's not windy at all, gas demand rises because you're switching between gas-based production when it's windy and not windy. So what are the deals that we're looking at in the current trading environment? So what's the trading opportunity? So traders will generally tell you high volatility means lots of risk and lots of reward. So generally traders are comfortable with that because it gives them the opportunity to make a difference and make some money. What kind of thing does well in this kind of environment with high volatility? Well, really, it's anything with flexibility, anything that you've got the ability to switch up, switch down, to take advantage of spikes and troughs in prices. So in terms of deals and assets that are prevalent to the European energy markets, there we're looking at swing, storage, transport, and the ever-present LNG. So any asset or deal with flex in it is going to do well from a volatile market. Swing deals. So what is a swing deal? So swing is essentially taking a certain number of days of gas over a given period of time. So for example, you may take 30 days of gas within a 90-day period. So you've got the option to take 30 days over a time horizon of 90. And what does that let you take advantage of? Why are you interested in that? Well, really, it means that you're able to take advantage of short-term spikes. You've got to pick the 30 days that have the highest prices in the next 90. And if prices jump up and get really high, the money that you can make from your 30 days is higher. Swing deals have within them a contract price, which is usually a fairly stable price. They're usually constructed so the contract price has fairly low volatility. So when you look at it through time, it's usually a fairly stable line. That's the cost of the swing deal. And then the revenue of the swing deal is the hub price. So if I am buying gas on a swing deal delivered into the TTF European hub, then the value of that gas is the value of gas at the TTF in the European hub. So the money I make from the deal is the TTF price minus the contract price that I paid. The game that we're playing here is taking the highest X number of days over the deal. So in the example I just gave, we're picking the highest 30 days out of 90, and we're trying to capture those days where the hub prices are above contract prices. So if you think of what's been going on in the TTF recently, if there was a particular event, so if there was a sudden drop in supplies from Russia, or if it suddenly got very cold, you would see a spike in prices. And if you are holding a swing contract, you're able to take advantage of that spike in prices and profit from it. What's the motivation behind the deal? Doing the deal. So if you're buying the deal, really you're profiting from those short-term spikes. So you will make money as long as those spikes are more than whatever you paid for the deal. The seller has the opposite motivation. There's also a big portfolio element to this. So swing deals are often sold as part of long-term gas deals. So they're done as kind of a bigger portfolio structure. And on a portfolio basis, they also give you a lot of insurance. So if you're looking at someone that is exposed to sudden jumps in a gas price, so for example, a power station owner that uses gas as an import may be exposed to sudden spikes in the gas price. Having a swing deal over the top of their gas plant ensures them from some of those spiky risks, so some of those big costs that they would incur from those spikes in gas prices. So they make sense on their own at the deal level, and then it's also important to see how they look in relation to a portfolio. So here we have our example swing deal. So we are taking on a Brent index. So you'll often see this with swing, where the price that you pay is based on Brent. So 12% of the Brent price plus $40 is what you're paying. You receive the value of the gas, which is the TTF price. The duration of this deal is Q4 2022, so October through to December. On a daily basis, the maximum amount that we take is 100,000 units and minimum is 0. And the maximum quantity we can take over the entire life of the deal is 3 million units. So those of you who have a head for maths will work out that there are 90 days in total over this deal. And if we take 100,000, we will have used our total allowed capacity under this deal in 30 days. So this breaks down to saying we have a 90-day horizon and we're picking the top 30 days in that 90-day horizon. So this is essentially what I was just talking through. We're picking the best 30 out of 90. Our cost is the contract price, which is Brent index, and our revenue is the value of gas, which is the TTF price. All right, so let's have a look at this. So the top right chart that we have here, right at the start of the swing deal. So we're looking at the 26th of September 2022. Our swing deal starts on the 1st of October 2022. And here we have the prices of TTF, so our gas price, and the price of Brent, which is our cost, on the bottom part of the chart there. So you'll notice that TTF is above Brent through the entire 3 months, but it's much higher during December. So during December, you can see that TTF is around 56 bucks and the Brent price is around 52 bucks. So this chart at the bottom here is showing us the difference between those prices. So you can see October, it's around $1.50, November, just over $2, and December, $4.50. So easy decision. You've got to pick the best 30 days. Which 30 days are you going to pick? You're going to take 30 days in December. So basically the whole of December. So that's what we call the intrinsic value of the deal. That's the value of the deal on day 0. Now, where swing gets interesting is how that value evolves as you move through time. How do you capture value from this deal? So as we're moving through October and November, spot prices are going to move around. So if, for example, the war in Ukraine gets worse, the weather in Germany gets really, really cold, or the wind drops to almost nothing in Germany. So if it's cold and not very windy and there's geopolitical issues going on, you'll see spikes in the spot price for TTF. So the spot price for TTF jumps, and if it jumps above where the December price is, so let's say in this example, our December value was $4.50, spot price has jumped up to $7. What we do is we bring one of the days that we were going to take in December and we take it today, and we reduce our December hedge by 1 day. So now we're going to take 29 days in December, we're going to take 1 day today, and we make the difference. So in that example, we make $7 rather than $4.50. We've made an extra $2.50. We've captured some additional value. And as you move through October and November, prices move around, and that's how you pull out the value. So the deal owner, the holder, wins if you get these very spiky prices. And at a portfolio level, the holder adds diversification and insurance to their portfolio from price spikes. So there's these two different reasons that you'll take the deal. So how has this performed historically? So if we look at Q4 2021, that's last year, so roughly this time last year. So we were actually going into an energy crisis this time last year, as per Forbes wrote an article, Europe's self-inflicted energy crisis, October 2021. Brent was at a 5-year high. Natural gas had already gone up 5-fold. So everyone thinks that everything went crazy this year. It actually all started last year. There was a big boost in demand in Europe for everything on the back of COVID reopening. So huge industrial demand, massive demand for gas. There was extreme weather events, so there had been a very hot summer and then followed by a very still autumn. So production from wind throughout Europe was very, very low. There was a series of supply chain disruptions. There was curtailment from gas coming into Russia well before the events that have happened in Ukraine, which people didn't understand at the time. So there were low and fairly intermittent flows from Russia, and storage inventories were relatively low. So there had been a lot of gas use over the summer. So coming into Q4, there wasn't much gas in store, kind of the opposite of what we saw this year. So what did that do? So here we have on this chart, we have the outturn December. We have the December spread. So this is where we're intending to take our gas, was December, and then the red line is showing us the spot spread and how that moves through time. So right at the beginning on the that I've shown here circled, that was the 4th of October. So on that day, very, very low wind production in Germany. A lot of uncertainty around supplies coming out of Russia. People didn't understand what was going on with Nord Stream. Prices spiked up. TTF hit 115 euros, which was a record at the time. I know it doesn't seem too exciting now, but at the time that was a record. And that spread jumped up. So the money that you could make for taking the gas on the 4th of October versus taking it on at December is the difference between the red and the blue line there, which is roughly $10. So through 2021, there were lots of opportunities, especially at the beginning through October, to pull gas short term instead of leaving it to take in December. 2019, so we often present these things and it looks like you always make money from them. That's not the case. Markets change every single year. 2019, things were a lot more stable and the spot price behaved in many ways and stayed relatively steady relative to December. 2020, the following year, which was just kind of post-COVID, there we saw initially prices relatively subdued until we got into November, and then prices really started spiking up. So there's lots of different situations under which money can be made from swing contracts, and it's important to understand what are the risk reward payoffs that you're looking for the trade, for the deal on its own, and what characteristics do you want to add to your portfolio. Now, we've focused in very heavily on a specific type of swing deal here. This table, we've shown lots of different types of swing deals. The first 3 lines are showing you how prices in swing deals can change. So you can have them based on a commodity index, which was the example we went through, like a 12% Brent index. They can also be pegged to gas, so you can have it based on the December TTF gas price. They can be fixed, so say at $50 flat. And then they can have different combinations of flexibility within them. So they can be entirely what we call a swap contract. They can be entirely a strip of calls. They can be combinations of swaps, calendar spread options, and calls. So there's a lot of complexity in the deals. Different people like to trade different types of deals, and our software can handle all of these different types and complexities. All right, now the next section we're going to go through modeling intrinsic and extrinsic value and how you go about working out what the value is from these deals, which Chris is going to go through for you now.
Okay, thank you, Martin. So I'm going to look at issues that need to be addressed when you're looking at trying to put value on these deals. So Martin outlined a current type of structure that's popular. I saw there was a question which we'll deal with the questions at the end. It's probably one for Martin about what other types of flex deals are popular at the moment. But Martin went through this flex deal and showed like historically what the payoff would have been in different historical years. What the next few slides look at doing is to try and understand how to value these going forward through time. So Martin's Brent and TTF forward curves were on the 26th of September, and we're looking at the period covering Q4 2022. So we need to model the uncertainty of those variables over that time period. So in order to do this at a high level, in order to value these gas deals or other deals with embedded flexibility, so this might be an analogous situation is storage, we're essentially interested in understanding 2 main components. One is what valuation methodologies exist to be able to capture the deal's flexibilities and constraints. So there are constraints on the number of days, there are constraints on how much you can take per day, there's constraints over the period, but then there's flexibility of when you can take it. Similarly with storage, there's a period over which there's a capacity of the storage, there's daily injection and withdrawal rates, they're all constraints, but then the flexibilities are the holder of this storage contract or the operator of the storage facility can inject when they want, do nothing, or withdraw. So this combination of flex and constraints associated with that, it requires certain valuation methodologies, and we'll go through those in a moment at a high level. And then the second main component is, in this example, we've got 2 sources of uncertainty. Brent's moving around, TTF is moving around. So how do you model the underlying uncertainty in the relevant variables? They're the 2 things that we need to look at. Let's look at the first question first. So there are a number of different valuation methodologies that exist to be able to capture this type of flex structure. I'll talk about 4 of them. The first one is intrinsic. This is really not, you don't need to do any modeling here. This is just based off the current forward curve. So the intrinsic value of the deal is, as Martin said when he was talking, the valuation is just based on the current forward curves. So in this example, it's the spread. So the intrinsic value is going to be the spread in December multiplied by 3 million MMBTU. That's going to be the intrinsic value. So whatever value is embedded in the current forward curves, that's the intrinsic value. and that's a set and forget. You can set that up now and you will capture that level of value, whatever happens in the market. The second valuation methodology looks at taking that intrinsic hedge and rolling it through time. So you set up your intrinsic hedge with its value on day 1, 26th of September, and then you roll through time. So periodically, and this might be daily, as the forward curves move, you look at, if you were to establish the intrinsic hedge on that new day, could you capture more value than that which you captured initially? So as the curve moves, you might have less of an emphasis on December and more on November. If you're looking at storage, looking at summer versus winter months, you might pick certain months to inject and withdraw, and as the curve moves around, you want to unwind some of those long positions to buy gas and short positions to sell gas to lock into a higher level. And so that's what you do with rolling intrinsic. You also obviously have to take into account that you've set some hedges up already, and say you're long December, and now you want to sell some December. If you're selling at a lower price than you bought, then you're making a loss on unwinding those hedges. But if the total increase in value from the intrinsic perspective is more than the losses of unwinding those hedges, then you can lock into a higher level. That's rolling intrinsic. The third methodology is spot optimization. So here you typically model the spot price. Beforehand, we were modeling the forward prices. Now, that spot price evolution will still be consistent with the initial forward curve, but you're modeling spot prices and you're making decisions: take gas today or not, inject, withdraw, do nothing for the storage facility. You make those decisions based on the modeled spot price outcomes, and you look at maximizing the value that comes from the ability to trade the spot and to take gas at more advantageous prices on certain days than others. And then the third one would be a basket of replicating derivatives. So essentially you convert this complex deal into an equivalent replicating derivative portfolio, typically swaps, options, calendar spread options, that has the same payoff characteristics as your more complex deal. So that derivative replication strategy, because it has the same payoffs, it has the same value, but now you can monetize that value by trading the underlying swaps and options and calendar spread options. So we do all of these, for example, for storage, and similarly a subset for gas swing contracts. So that's the first question in the top bullet point: what valuation methodologies exist? The second one is equally important. We need to model, in this particular case, we need to, for this example, Martin's example, we need to look at the spot spread between TTF and 12% Brent plus $40. So the this constant of 40, typically that sort of 12% is typical scalar representing long-term average between sort of Brent to gas conversion. 40 is chosen to bring this deal in line with sort of current market conditions. So the payoff is dependent on this spread. So really we need to model this spread forward through time. So this is the previous 2 months up to the 26th of September. This is how that spread evolved. And in terms of valuing this deal, we want to be able to model this forward between the 26th of September and the end of December. Now, there are a number of ways of doing that. Oops, wrong way. Firstly, I'm going to outline two. They're sort of the two main ones. What I call the outright model here is saying, well, we're interested in how TTF evolves, and we're Brent evolves. So let's have a model for TTF, a model for Brent, and we probably want to link them, probably via correlation, most people do. And we will simulate those out forward through time. So this is the simulation. These are 10 simulations of the spread implied by modeling TTF and Brent. So we model TTF and Brent together, and we take the difference between the two according to the equation on the top left-hand side, and that is our implied spread. So these are 10 simulations of that implied spread. If we look back in history, it's only a short history here, but if we would find similar features if we looked at a longer time period, that spread tends to remain in some sort of relatively narrowly defined band, even though it's sort of blown out to what we would have looked back over the last few years. But if you look at the simulations over here on the right-hand side, the implied spread can go up and stay at $60, $70, $80 per MMBTU for long periods of time. Well, we probably don't see that in history. And again, this spread has gone negative. It's down minus 20, 30, 40 bucks, again, for long periods of time in this simulation here. So sometimes if we're looking at modeling the spread, then modeling the components of the spread and recovering the spread and linking them via correlation can lead to some unrealistic simulations. You know, a trader will say, well, you know, those kinds of spread levels are never going to happen. The second way of modeling that I'm going to talk about here is just modeling this spread directly. Yeah, we've got a forward curve for TTF, we've got a forward curve for Brent. We can imply a forward curve for TTF minus 12% Brent, plus 40 bucks. We can calibrate history. There's 2 months of a history here, and we can simulate those prices directly. So obviously you have to be careful about how you calibrate the models, etc. But you don't get these effects of these sort of very high prices, very low prices, because you're keeping the spread around the forward spread curve with, say, some sort of mean reverting model or something like that. Right, so at a very high level, those are the kinds of issues that you deal with when you're looking at the valuation of these deals. Okay, so in terms of this actual deal that that Martin was talking about, based off the initial forward curve, as Martin said, the expectation is that the 30 highest days will be taken in December, and so the December contract is the initial hedge, and so the original December spread was $4.36, 3 million MMBTU, so we're looking at an intrinsic value of the $13 million. Now with this, so we're just using the rolling intrinsic, we picked the rolling intrinsic to use here. With the rolling intrinsic, we run a number of simulations. So we run 1,000 simulations, and we go through that process that I described before. You start off with the initial intrinsic value, and then you simulate out the spread in this case until the end of December, and you make these decisions about when to take gas, how to unwind the hedges, etc. And under each simulation, you get a value, and then you can look at the distribution of values. So this spike here at the beginning says that out of 1,000 simulations, about 90 to 100 of them, you got no extra value. The value that you got at the end was the same as the initial intrinsic value. Now, as I described the methodology, you can never you will never change your initial hedge unless you make more money. So $13 million is the bottom level that you get, and in this case we had about 10% of the simulations where under those simulations we didn't change that. But there were obviously lots of other simulations where we did take advantage of re-optimizing the hedge, capturing extra higher value associated with this rolling the hedge through time. And then if we take the mean of this distribution, then that gives us the total deal value. And then the difference between the intrinsic value and the total deal value is the extrinsic value of the the deal. So 1,000 simulations, we re-optimize the hedge on every day until the end of the life of the deal. Now, one of the things that we sort of pride ourselves on at Lacima is not just to give these sort of high level numbers, but try and give people insights into what's driving that. So as part of the analysis that we've done, we've shown pick out individual simulations. This is simulation number 28 out of 1,000. And we've plotted here the simulated spot spread. So remember, that's the spot TTF price minus the spot Brent price versus the December spread, which is the forward December TTF price minus the forward Brent December TTF price over time. So we get these two simulations here. And when the red line is, so the red line is above the black line or dark green line or whatever it is, so spot is above December, then the value of spot is higher than the December hedge, and you'll take volume. So an extra sort of output here would be looking at what is the implied strategy dependent on take, you know, when do you take gas and under this, and what does it imply about the level of contract volume. So this graph on the left hand side is the contract volume, starts off with 3 million MMBTU, and you can see how it moves through time with a blue line, and I'll talk about that. Over on the right hand side is how much you take and when you take it under this particular simulation. So these orange bars here are gas that's taken under those under that simulation, and the bottom graph shows us the cumulative P&L. So I'll stick a couple of arrows on here. So if we look here, the spot price is above the simulated December price, so we take gas under that. That leads to so the orange bar down the bottom is the amount of gas that's taken on that day. The blue decrease is saying that the contract volume has decreased from 3 million, and the cumulative P&L has gone up. Now, because we're taking gas earlier than December, which was our initial hedge, then you take the gas on that particular day, you reduce the December hedge by a day's worth of volume. Move that picture over here. So the orange bars are the days we've taken gas, reduces the gas to take. And so in this particular example, so this simulation 28, you can see that we've taken all the gas because of these higher prices here through October into the start of November. We take a lot of gas early. So under this particular simulation, we've taken all of the gas by about, I think it's like the 14th of November. Right, so you can get a lot of insights into what the model is doing from a simulation perspective, what it implies about the gas that's taken, what that implies about the contract volume, what that implies about the cumulative P&L under each of those simulations. All right, then my last slide is really what typically happens with any of this analysis is you set it up, you've got the deal characteristics, you've got your model, you calibrate your model, you run simulations, you get values, but now you want to do scenarios and stress tests. So Martin showed an example of scenario analysis. If you run last year's data through the current structure, what would it have paid off? Right? There's only one historical time series there. We're looking at simulating 1,000, but what would have happened last year for this particular structure? So that's the kind of scenario analysis that people do. And then obviously stress testing. What happens if vols go up? This is a 30% increase in the volatility functions of the multi-factor model we use. What does it go down if we're modeling 2 variables? What if correlations go to 1? So essentially you rerun the analysis under those different stresses or different scenarios to understand how sensitive the outputs are to the inputs. What happens if forward curves shift? What happens if often it's not an absolute shift that's important, and this deals in a classic example of that, but it's how does the October, November, December prices move relative to each other? Or for storage, how does summer versus winter prices move? Those kinds of scenarios are great to do to gain insights and to be able to communicate with senior management. Yes, this is the value, this is the extrinsic value, this is how you monetize that by trading portfolio derivatives or whatever, and this is how sensitive it is to the inputs, this is what happens if you run last year's numbers through it, etc., etc. All right, so we're running a little bit late, but we left some time for some Q&A. So see if I can. I'll go for the first question. Okay, one of the things that I did initially was to give the wrong time. I cut and pasted it out of the of an old email. So Robert was right. Lucas responded to that. The CET, the Central European Time webinars taking place at 10 Central. Let's pick one for you, Martin. Okay, yeah, this is a good question. Ivan asked this. So, how much interest are you seeing in the market for swing deals? But make that wider, right? The swing is just an example of flex. So these types of flex type structures in this currently highly volatile market.
Yeah, so we're seeing a lot of interest at the moment in swing. There's a bit of an overlap with LNG because a lot of LNG deals have swing within them. But yeah, everyone at the moment is looking at flex. We've been very busy with a lot of different clients looking at different types of flexibility. Swing has really kind of started going up in terms of what people are interested in. A lot of that's kind of overlapping with what's going on in LNG, and a lot of it has come down to kind of the extreme spot price volatility that you're seeing in Europe. So yeah, the main swing is a really big part of what's been going on. Transport's kind of ticked up as well, as there's been a lot more differential in Europe than there is normally. And the LNG deals, flex and LNG deals has also been really big. So across the board, anything flex people are interested in.
Are you saving energy by turning your lights off?
I'm not sure what happened, Chris. I think there may have been a power cut.
Oh, right. Okay. Well, how about I ask myself one of these questions, because I can combine two of them. So KD asked, what price model are you using in your valuation software? And YZ asked, would these valuation methodologies that I had on slide 13 give different results for the same deal? So the answer to KD is that there's no one model. So when we're running, say, simulations of rolling intrinsic, it could be a spot price model, like a single factor mean reverting model. The user could calibrate a multi-factor model or multi-factor spread. So in the example that I gave here, we actually used, of the two on the right hand side of my simulations, we actually used the bottom one. So we modeled the spread price directly. So we had forward curve for Brent, forward curve for TTF. We could look at the forward TTF minus 12% Brent plus $40. That gave us a forward spread curve. And then because we had a history on the left-hand side of that slide, simulations, it was an actual historical time series. Now we would use more than 2 months, but we've got the history of the spread, so we can calibrate a model to that. So we actually, I think we calibrated a multi-factor forward curve model to the spread. But in different parts of the software, we have mean reverting models for spot optimization for storage and swing, multi-factor forward curve models, spread models. I mean, the user has quite a range of choices in order to be able to do that, and there's lots of modeling frameworks within different parts of the application. And then in terms of if the valuation that I gave was based off this rolling intrinsic on the spread, but we could have picked any of the others. So in terms of would they give the same result? No, they won't give the same result because they are different optimization routines and they're different underlying models, and they have different calibrations. So for example, if you use spot optimization, with rolling intrinsic, as long as there's an initial positive intrinsic value, the value that you get will never be less than that, because in 10% of my simulations, we didn't change it. There was no points during the simulation where that spot spread went above the December spread and we took the gas early. So that's the least amount of money that we can make. But so that distribution will always be to the right hand side of that. So the extrinsic value will always be higher. Now with the spot optimization, if you would start off with the same initial forward curves, but let's say the simulated gas price never went above. So the December spread, let's say it collapsed, and the simulated spread never went above that contract price. Now you're forced to take 30 days worth of gas, even though you're taking it at a loss. So there'll be some, when you do the distribution of those, there's a possibility that you'll get negative values. Now you might also get some really high positive values, so that when you look at the distribution, you'd expect the value to be, the mean of that to be positive, and also probably higher than although you need to sort of calibrate like for like with the models, higher than the rolling intrinsic, because you're able to take advantage of this sort of daily volatility.
Chris, we got time for one more question.
Yeah,
I think there was.
Let me flick one back to you. I guess it's similar to before, but yeah, what types of deals would you recommend in the current environment?
Yeah, so basically anything volatility related is what people are looking at. The thing that people are starting to get concerned at the moment is, volatility is already priced in. So where you're looking at flexible assets, they actually have a really high price now because we've been through such a volatile time. So the really interesting thing from my perspective is the German storage levels, which I pointed out at the beginning. Prices get really interesting when you get to major constraints. So if German storage gets full, where does that gas go? What happens to price? You may see very heavy falls in short-term prices to get gas out of the system if German storage gets full. So I'll be looking at flexible assets that can pick up, that take advantage of dips in short-term dips in gas prices. So there's some swing structures that do that. DQT options on LNG contracts do that. Diversion options out of Europe do that, and storage contracts do that. So I would be looking at deals that can take advantage of short-term dips, just because I'm not saying that prices are going to fall, but I'm just saying that there is a risk that if German storage gets really full, you could see volatility to the downside in price. Okay. Chris, we've got 5 minutes left. Did you want to wrap up?
Yeah, well, we were going to finish by about 10:02, to be honest, so we've gone a bit over. So yeah, I'll wrap up. So thank you very much. Thank you to Daniel from EEX for the introduction, and to EEX in general for the opportunity to be able to present in this kind of webinar, EEX webinar forum. Thank you to all the participants for your attendance and attention. Yeah, I think we handled most questions, but if we didn't address any, if you've got any further questions outside of this webinar, often people don't like asking things in the Q&A. Obviously, let us know. I've left the contact details up here of the Lacima people. I'll talk about them briefly in a second. So all the analysis that you've seen today, the simulations, the valuations, the stress testing, was performed using tools in our Lacima Trader swing library. So if you want to understand more about our solutions and how they can be used to value deals like this and some of the other deals we'll be looking at in the future webinar series, or how they can be used to perform risk analysis on portfolios of deals, then please reach out to one of our 2 London-based sales representatives. So Ivan and Stephen, their contact emails are here. They'll be happy to talk to you. If you're an EEX member, please feel free to involve your key account manager with our guys in any conversations. So, and as Daniel said in the beginning, I think as part of the chat, in the next few days, when the marketing and communications team have tidied up some of our sections, this webinar will be posted on EEX TV on YouTube. So thank you very much. Good morning if you're in Europe. Good afternoon, evening if you're here in Asia, and thanks again.